Welcome back to the Emerald Corner. In today's episode of Tax Tip Tuesday, we're going to be talking about short-term rental loopholes and how you can utilize them to save big on your tax return. Well, hey there. I'm Kimberly Ferguson, CEO and founder of Emerald Expectations Accounting. I'm so happy that you're here. The Emerald Corner is a place where life and business meet. So I want to share with you how to have a growing and profitable small business while maintaining a life with your loved ones. Today's video is another episode of Tax Tip Tuesday. And for those of you who don't know, Tax Tip Tuesday is where I share with you tips and tricks on how to get ready for tax season, how to save money on your taxes, and answer your specific tax questions. So if you have a specific tax question that you want me to answer, please drop that in the comments. I would be happy to make a video just for you. So today's video is all about short-term rental tax loopholes. Okay, so there are two main loopholes that we're going to talk about in this video. Now, keep in mind that I will also share with you that there are a lot of different requirements in order to meet these loopholes. So if you're not working with a tax professional on this, I highly recommend that you do, okay? So the first one is kind of what most people refer to as the short-term rental loophole, or sometimes like the Airbnb loophole. And so basically what happens is if you have a rental property, in most cases, this is going to be considered passive income for you. The problem with that is that most rental properties end up taking a loss because of depreciation and all the expenses and stuff that they can utilize. But you are limited to how much you can take in losses. You can only take passive losses against passive income. So if you don't have any other passive income, like investments of other kinds, then you can't take those deductions. They have to be rolled over into future years so that you can utilize them in future years when you have passive income, right? So the way that a lot of people kind of get around this is if you are a real estate professional. However, again, caveat, in order to be considered a real estate professional, generally speaking, you have to have put in 750 hours in a year working on the rental property, right? Or working on rental properties. Most people who have another full-time job aren't going to be able to meet this requirement, okay? So there is a loophole, and it is for short-term rentals. So if you have a rental property and the average stay of a guest is 7 days or less, and the owner materially participates in the activity, then the activity can become non-passive, okay? So like I said, if it's passive, then losses can only be taken against passive income. But if it is non-passive, then your losses can be taken against non-passive income, such as a W-2 job, such as another small business. So what does it mean to have 7 days or less as the average stay? So take a look at the guests you have staying with you. As long as the average stay is 7 days or less, it doesn't have to be every single stay, but as long as the average is 7 days or less, then you might qualify. Now, materially participates is a little bit more tricky. The main qualifications for this particular spot is that you participate more than 100 hours on this activity during the year with no other individual spending more time than you. Hey there, future Kimberly here, noticing that I left one important detail out of this video. So not only do you have to work at least 100 hours on the business, and you have to be the person who does the most amount of work in the business, you also have to provide substantial services. So this could look like cleaning for the apartment, food and beverage services, something that kind of goes above and beyond just a normal rental property. So think long-term rentals. You don't really supply any kind of services to a long-term rental except for maybe, lawn care, snow removal, that kind of thing. But anything kind of above and beyond that could be considered substantial services, okay? So if you spend 110 hours a year and then you have a house cleaner and they spend 60 hours a year, then you're fine because you worked more than the cleaner. However, if you spend 110 hours and a cleaner spends 120 hours, you no longer qualify because somebody else is spending more time on the business than you are, okay? Now, the second short-term tax loophole is called the Augusta rule. And basically, what this means is that you can rent out your personal residence as long as you do it for 14 days or less in any given year. Then you can be paid rent for the time that you are renting out your home. There are a lot of caveats with this. The biggest one being that it has to be rent comparable to your area for the size of your home, for, the facilities that you're providing, for any services that you include with the rental, all that stuff. It has to be equivalent to areas around you. So this involves doing a lot of research, making sure you have comparable properties to show and document, and make sure that you have a good rental rate that you've established. The other thing is that you have to have a lot of documentation and a lot of paper trails. There has to be a rental agreement with, everything that's going to be included, what the rates are, when the payments are due, all this other stuff. You have to have invoices. You have to keep copies of any checks received. You have to keep documentation of any type of event. If you are renting to your own business or something of that nature, you have to keep documentation as to what you actually did during the time that the business rented the home. So lots and lots of documentation that needs to be required. And if you do this more than once, you have to have all that documentation for every single day that you rent out your home. So as you can imagine, not only is there a lot of research involved, but there's a lot of documentation involved, which is why I highly recommend that you work with a professional if you try to utilize this particular strategy, because it does tend to be something that might bring the IRS's attention to your tax return if it's done incorrectly. So thank you so much for spending a few minutes of your time with me today. I hope that you have a fantastic day, and I will see you in my next video.